Governance, Scope and Approaches. Part A. Analyse and discuss the role and influence of institutional investors in governance systems and structures, including the roles and influences of pension funds, insurance companies and mutual funds. Institutional investors are investors who hold a sizable portion of shareholding in any one company in a portfolio of shares, as in pension funds, insurance companies, venture capital organisations and mutual funds. Institutional investors are the biggest investors in many financial markets and have an amount of money to invest, so they are governed by very few protective regulations, considering they are knowledgeable and able to protect themselves. Institutional investors play a crucial role, considering their authority on the board of the organisation, and can influence the governance system and structure of the organisation in different methods, such as one-to-one meeting, having a face-to-face meeting with the management of the company where they discuss strategy, the fulfilment of objectives, and reviews how efficient is management in achieving the objectives. New information cannot be provided to any investor in these meetings, since it will give a competitive edge to them over others. Voting. Usually institutional investors work in sync with the board of the organisation. If they want to oppose a resolution, they should let the board know about their position in advance. Many corporate governance reports stress on the importance of institutional investors exercising their votes regularly and responsibly. Focus list. Compiling a list of underperforming companies, such companies' boards may face some challenges. Contributing to corporate governance rating systems. These measures key corporate governance performance indicators, such as the number of non-executive directors, the role of the board, and the transparency of the company. Part B. Compare rules versus principles-based approaches to governance and when they may be appropriate. Principle-based governance uses a broad series of ideas to set corporate governance behaviour, usually requiring compliance or explanation disclosure, for example the UK Corporate Governance Code. Rules-based governance is based on inflexible rules that must be complied with, or else face sanctions from a regulator, for example the Sarbanes-Oxley Act in the USA, commonly known as SOX. Principle-based governance is preferred in legal jurisdictions where the governing bodies of stock markets have the prime role in setting standards for companies to follow. Rules-based governance is favoured in legal jurisdictions where great emphasis is put on obeying the law rather than only the spirit of it. Part C. Discuss different models of organisational ownership that influence different governance regimes, family firms versus joint stock company-based models, and how they work in practice. Commonly, corporate governance systems around the world in different governance regimes are divided between insider and outsider models of ownership. In real life, most regimes fall somewhere between the two systems. Insider system or relationship-based system happens when most of the listed companies on stock exchanges are owned and controlled by a small number of dominant investors. Often family-owned and run organisations fall in this category. Other shareholders could be banks, other companies, or even the government. Outsider systems are where shareholding is more widely dispersed by a large number of investors, and there is a manager-ownership separation. Shareholders can come from any background and can have both small and large holdings. Institutional investors include the investors such as pension funds, insurance companies, venture capital organisations, and mutual funds that make up a sizable proportion of shareholders in any one company, usually for the purpose of holding a portfolio of shares. Institutional investor funds are generally managed by a fund manager, who targets to achieve higher returns for investors in the funds by using lots of different sources of information. Usually agency cost is high since they track the performance of all investments that the fund makes. Part D. Describe the objectives, content and limitations of governance codes intended to apply to multiple national jurisdictions. 1. Organisation for Economic Cooperation and Development, OECD, Report 2004. 2. International Corporate Governance Network, ICGN, Global Governance Principles, 2014. There are 2 regulatory guidance codes which apply to multiple national jurisdictions. The Organisation for Economic Cooperation and Development, also known as OECD, developed its Principles of Corporate Governance in 1998 and updated them in 2004 and 2015. They are non-binding principles intended to help governments in their efforts to evaluate and improve the legal, institutional and regulatory framework for corporate governance in their countries. They also intend to provide guidance for stock exchanges, investors and companies. OECD principles mainly deal with governance issues, which results from the separation of ownership and management of a company. The International Corporate Governance Network, also known as ICGN, first issued its Global Governance Principles in 2005 to support the OECD principles. ICGN principles set out the corporate governance responsibilities that should be followed by boards and institutional investors. ICGN believes that companies will only achieve value in the long term if they effectively manage their relationships with different stakeholders. Limitations of ICGN and OECD are as follows. Follow one-size-fits-all approach, which may not be appropriate for all organisations. They are non-binding, therefore reducing their relevance. Different countries and regions have their own legislative approach, which may undermine some provisions of internal codes. Ignores the fact that countries have different preferences with respect to corporate governance. The pursuit of international consensus with respect to international corporate governance leads to a lower common consensus, which increases the chances of poor quality governance.